Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. In this episode, I'm going to provide some practical guides to implementing the investment policy.
This is the Family Office Sherpa.
In this episode, I thought it would be a good idea to go through some of the most common reasons family offices stall at implementation. So they get the investment policy in place or they agree on process and things like that, but they fail to implement or they find implementation challenging. So what I'm going to go through is some guides around this, some of the governance structures that can really help, and some practical tools that turn what you'd call a policy document, investment policy, which is obviously what I help a lot of clients with, into a portfolio, right? So this is going to be good for anyone deploying capital, for those looking to try and bring discipline to existing implementation and portfolio management, but also those that are going, well, we have this in place, now what? So this one's for you. So number one, the fear of timing. I think everyone's got this, right? Which is the strategic asset allocation. So getting that in the investment policy or wherever that sits in terms of your documentation. So your strategic weights to each asset class. I mean, that's kind of the easy part to a certain degree. Like you get that from capital market expectations, your own internal expectations, your advisor expectations, whatever it is. But it's still theoretical. It's a theoretical construct in a spreadsheet, right? The moment you have to deploy real capital, that's when emotion takes over. I remember the first trade I ever placed when I was a stockbroker or an equities dealer, and it scared the absolute crap out of me. It really did. And it was just one of those things where, you do overthink, you do get bogged down into analysis paralysis, but just it's a very challenging thing to do. And I absolutely empathize, right? And emotion takes over a lot of the time. You get asked questions like, what if the market drops next week? Is the question that keeps allocators or people that are looking to invest, paralyzed for months, sometimes years. So offices can sit in cash a lot of the time, earning what you call suboptimal returns, especially when inflation's running a little higher, whilst waiting for what you'd call the perfect moment. And I can tell you right now, their timing is almost impossible, right? It's such a hard thing to do. And at that moment of perfect timing when everything's in place and all the rest of it, it's most likely never going to come. And if you manage to time it incredibly well, good for you. But what we're talking about here is we're trying to take that fear of timing out of it, right? The gap between having a policy, living a policy is where most people fail, right? That's a real challenge. So what's the role of the investment committee here? Number two, the role of the investment committee is not there to manage the portfolio. That's the advisor or the CEO or the internal investment manager's job. The role of the investment committee is to hold the process accountable, not to do things like second guess trades and things like that. That's not, in my opinion, anyway, the role of the investment committee. It's the investment committee is the governance layer, right? Think of it that way. They set the expectations, they approve the framework, and then they trust the process that they signed off on. And once you sign off on that process, like this happens, it happens now, which is someone has put a process in place on the investment side and we've gone, yes, that makes sense. We understand what they're trying to achieve or what they are going to achieve, and it makes sense for us. So we sign off on that. Subsequent meetings are not necessarily about, was it a good investment or a bad investment? At that time, it's more, did they follow the process? Are we still comfortable with the process? Is it still meeting our expectations around the investment policy? That's, you often I see one of the most common dysfunctions in family offices is that is that the investment committee drifts into portfolio management. And honestly, debating individual stock picks or reacting to headlines is not really a good use of the time, and it's not the purpose of the investment committee. It's more a centralized North Star of, are we operating within the bounds of our investment policy statement? That's it. The right questions from an IC sounds like, I don't know, are we on track with the implementation? Is the portfolio behaving the way we expect or the investment manager expected? Not, should we be buying this asset class now or that asset class now? An effective IC also plays a critical role in managing the expectations. It really, really does. Because where you see the investment committee, it is often made up with family members, but there is often a family board or some version which we're reporting up to, and we're managing the expectations there for a lot of the time. Setting realistic return assumptions, communicating why short-term underperformance is not necessarily a signal to abandon strategy. Really reinforcing long-term mandates that that the investment manager's been given. Like, this is their mandate. If you say you're a long-term investor and they're implementing that, and I'm bringing it always back to implementation, don't judge it on one quarter or one day or whatever it ends up being. If you say you're a long-term investor, act like one and give your managers and the people you are trusting to implement it for you the time to do their job, right? And really, when markets get volatile, this is the really strong role of the investment committee, because it's a stabilizing force rather than one of noise. They've already agreed on the guardrails, so the conversation should be calm and structured. And another really important piece around this in terms of implementation is document the outcomes and decisions that were made in that investment committee. Creating a paper trail, what that does allow them to do is protects the family and the advisors and the investment management team. It makes it harder for hindsight, all these sorts of things that can, to a certain degree, rewrite history. So that's where I see the IRC's role within implementation. Number 3, another one is make it process driven. Removing as much of the human discretion as possible from the implementation can really improve the process, right? Or improve the experience. A documented implementation plan, and what I'm talking about there is one that's been approved by the investment committee before. We're not talking reactive necessarily, and sometimes it ends up being because of the reason, there might be a big market fall, and that's the reason we have that conversation. But the best case scenario is that we've already got this in place. This decision tree, these processes in place. Think of it, I don't know, like a bit of like a pilot's checklist. You're not trying to improvise here. We're trying to execute. The process becomes the authority, not the individual. Someone once asked me, what's the veto process within sort of the family office structure and governance? The investment policy in the process is the veto structure, right? That's what it is, because it's inbuilt into there. And if we don't agree with it shouldn't be there. So make it really process driven. I'm not saying that there aren't nuances here, and there's, we can utilize specialists that can see, opportunities and things like that. Don't get me wrong. One of the greatest things about working with family offices is taking advantage of opportunities. But we take advantage of opportunities through a process, right? That's all I'm saying. And that brings me to number 4. Number 4, when it comes to implementation, there's the benefit of having an advisor to guide you, right? That is really, really helpful. A good advisor acts as a circuit breaker between things like between noise and capital market decisions. Often, they've seen this type of cycle before. This is especially helpful for offices that might be, just had their liquidity event, might have just had their, may have had an embedded office for a period of time, but really what they've been doing is, working on their business or building a business. So having someone there that has seen it before, seen this part of the cycle before, and can keep a level head on implementation is really, really important. They know that hesitation at the implementation point is normal. And they normalize it for the family. It's not unusual to be fearful about this. It's not unusual to think that maybe we should wait or, try to time them and things like that. But whilst it is normal to think like that, there still needs to be some version of action, right? They also carry the weight of experience, and a good advisor should act as, that governance bedrock as well. So if something goes wrong, the family has a documented professional process behind them, right? Accountability works both ways though, right? An advisor keeps the family honest. If the family says we want to do this, then they will make them, to a certain degree do it or help them get it done. So really, really important, a good advisor. Number 5, the psychology of implementation, right? A lot of the time people talk around, well, let's use an example that is often used when implementing, especially going from sort of highly liquid like cash into their strategic asset allocation. They use things like dollar cost averaging, right? The reason why is I think dollar cost averaging, if you look at the research, is not necessarily a great way to implement from a return or maximize return perspective, but it does something really, really valuable for families, which is to reduce some of that fear and potential regret. So that spreading of deployment gives the family across the board, because it's not just one family member often, especially if the family member is the person doing the implementation. They can say it was a disciplined process over like a 6 to 12 month period. It's not, we took our time, and I think most people appreciate that, right? It also builds familiarity with volatility, which is important for new families trying this for the first time, this new sort of more institutional strategic asset allocation, as opposed to we'll buy some stock or we'll buy this particular asset. The psychological benefit is real. It really is. And it's not necessarily, this is not a question of negative or positive. It's more, you've got to find the right way that you want to do this. And ultimately, as we've discussed a lot of the time, it's your money. So do it in a way that makes you comfortable. Do it in a way that is really there to make sure that you are able to follow this process. You're able to get there, right? And I think that's a really, really important one. Next one, number 6. Use rules for rebalancing. It's such a really hard thing to do, to rebalance your portfolio, which oftentimes includes selling winners and buying losers or underperforming assets, right? You got to have, I find in my experience that families do this well, have triggers or, pre-agreed bands that will take some of the emotion out of it. Have some things like drift tolerance, target weights, which allows you to, which means the decision to trade is already made, really. It's not, we're not making a decision to trade here. The process is already in place. The trigger is already in place. We should be doing it and take some of that emotion out of it. It's particularly powerful, I think, in down markets. So when markets are going down, the process forces you to in some instances, buy when instincts say, otherwise. So it's really, really important, I think, and really important to document the rebalancing rationale. It's such a good process to be in place, which is it builds, I don't know what you call like institutional memory or memory, and protects the offer from that hindsight bias. Number 7, diversification, if real, should allow for instant implementation, really. So what does it mean? So, true diversification across uncorrelated liquid assets will actually remove the timing problem. If you think about it, there's obviously some nuances to this, in particular around the sort of private market piece where you might get lag in terms of implementation. But let's use liquid investable assets at the same time that are uncorrelated. If you invested all of them straight away, even if you got the market timing slightly out, if they were truly diversified, which means that they're not all going to move up and down at the same time, then that's not a bad time to invest, right? So you buy, the liquid assets and they all implement at the same time. One goes up, one goes down, true diversification. And it's a really, really good step to make, because what it allows you to do is to see if you really are diversifying, or have you just got all assets in that looks like the public equities. If a family is hesitating because of a market crash, then that's the question you should be asking. Is it diversified, or are we just spread across a whole lot of correlated asset classes? That's a really good investing. There's no better investing lesson, I think, than actually seeing what happens to the asset classes that you're invested in, when one turns red and one turns green, and really to see if you are diversified. So, and that brings us to another one, which is number 8, which is that challenge with private market investment lag. And I put this in here because there is a significant amount of private investments that goes in terms of family offices, and that's where implementation timelines need to be a little bit more nuanced, right? Capital can stretch for long periods of time, but the reason why I brought this in, and because I think it's so important, is that families need to put in a realistic cash flow model that maps the capital calls against liquidity. And I think this is what people don't necessarily put in place before they start to implement their their investment policy, which is, okay, these private market assets, we might have capital call structures, or we might have structures where we do need to manage the cash flow because, these are potentially illiquid, but potentially we need to find liquidity to fund them because we've committed to them. So this is why portfolio construction is just so important. This is why getting good advice is so important, because this is the challenges. If it was just public asset classes or really liquid asset classes, then it's a lot easier. But when you've got this lag, particularly with private markets, it's the solution tends to be around sort of that there will be a lag in investment implementation, but there's also a secondary requirement there, which is to manage the cash flow. So I thought I'd put that one in there because I think we're saying that a lot lately, right? So in conclusion, implementing an investment policy, in my experience, is less around the financial component of it, and is really a human one. There's fear, hesitation, not understanding decision-making processes, investment committee dysfunction. That's what's going to derail that implementation more than bad markets, I would say. The families I see that get it right share a common thread, and that is that they built a process before they needed it, and they trusted that process when it mattered most. And oh my gosh, that is the big thing. They trust the process when it mattered most, because that's the hardest thing to do. Like I said, having to rebalance, having to pull the trigger on investments when you probably emotionally don't feel like it's a great idea. Like, this is why process is so important. And lastly, like a well-structured investment committee, a disciplined advisor, and pre-agreed implementation plan. Look, it won't guarantee outperformance, but what it'll allow you to do is that it almost guarantees that the strategy you carefully constructed actually gets a chance to work. And that's where I'll leave it. So if you're interested in understanding how I work with clients, please feel free to email me, Shaun, SHAUN, @wholeroad.com.au, or message me on LinkedIn. This is the sort of stuff that we talk about in investment committees. This is such an important thing. So I'm really happy to have that conversation. Or if you're looking at how an engagement might work, please email me. If you like the content, please subscribe to the Sherpa newsletter, which is going for over 7 years now and can be found at wholeroad.com.au. If you're enjoying the podcast, please ding the little bell so you'll get the notification when the next one is. And until next time, thanks for listening.